Today we're going to do something pretty cool. We're going to take a look at a company called Globe Life, but not just any old way. No, we're going to run it through the exact same playbook used by the world's most famous investor. We are putting this company to the Warren Buffett test. So that's the big question, right? How does a guy like Warren Buffett find these amazing companies over and over again? It's not some magic formula locked away in a vault. It's actually a really clear, repeatable process that boils down to just a few core ideas. Okay, let's get into it. And here's our roadmap for today. We're going to start with the checklist itself. Then we'll ask, is Globe Life's business predictable? We'll dig into its financial health, see if management actually likes its shareholders, and then, of course, the big one, is the price right?
First things first, let's talk about the framework. This isn't about some super complex computer model. It's really just about good old-fashioned business common sense, and it's broken down into 4 pretty simple steps.
So these are the 4 pillars of the whole thing. First, you got to ask, do I actually get this business? Can I guess with some confidence what it'll look like in 10 years? Then you dig into the numbers to make sure it's rock solid financially. After that, you check if the people in charge are on your side, rewarding the owners. And finally, the most important question, can we buy it for a good price? Let's kick things off with number 1.
Buffett absolutely loves businesses that are, well, a little boring. He wants companies that just consistently deliver, year in and year out. No drama. So the question is, does Globe Life fit that bill? Let's take a look at the data.
Okay, now what we're seeing here is consistency. That's the key word. Over the last 5 years, revenue has been growing at almost 5%. Net income, almost 10%. And earnings per share, that's the profit for each share of stock, has been growing even faster at over 11%. See, this isn't that crazy explosive growth. It's just steady, predictable, like a train on a track.
And that's the bottom line here. These aren't just random numbers from a lucky year. This kind of steady pattern is exactly what value investors are looking for. It points to a really durable business model that's hard to knock over. So, for our first test, Globe Life gets a big check mark.
All right, let's move on to the next checkpoint. A predictable business is great, but it's got to be financially strong too. So we're going to look at 2 really important things here: how profitable it is and how much debt it has. Just look at that number. 19.44%. Now, by itself, that might not mean much, but I'm telling you, in the world of investing, a number like this is a real powerhouse. It's called return on equity. So what does that actually mean? Well, it's a measure of profitability. It tells us how much profit the company squeezes out for every single dollar that shareholders have invested. Generally, anything over 15% is considered excellent. Globe Life is smashing that benchmark, which tells you it is incredibly good at turning money into more money.
Now let's look at the other side of the coin, risk. This number, 0.44, this is the company's debt-to-equity ratio.
To put that simply, it means for every dollar of its own money, the company only has about 44 cents of debt. That is a very, very healthy number. It tells us Globe Life isn't using a credit card to grow, which seriously lowers the financial risk. So on financial health, yep, that's another big check mark.
Okay, we are cruising right along. We've got a predictable business, and it's got strong financials. So now we have to ask, does the management team actually work for the shareholders? And one of the best ways to figure that out is to see how they give cash back to the owners.
What's so special about the number 20? Well, that's how many years in a row Globe Life has increased its dividend payment to shareholders. 20 straight years of giving its investors a raise. I mean, that speaks volumes about their commitment.
And get this, they're not just raising it, they're stepping on the gas. Look, over the past 5 years, the dividend grew by about 11% a year on average. But in just the last year, it jumped by over 22%. That is a very clear signal that returning cash to owners is a huge priority. Now you might be thinking, okay, that's great, but can they actually afford to do that? Is the dividend safe? Well, this number, just under 8%, is the dividend payout ratio.
And what that means is the company is paying out less than 8% of its profits in the form of dividends. That is an insanely low and safe number. It means the dividend isn't just sustainable, it has a massive runway to keep growing for a long, long time. And that's checkmark number 3 for Globe Life.
Okay, this brings us to the final and arguably most important question, because a wonderful company is only a wonderful investment if you can buy it at a good price. This is what Buffett famously calls the margin of safety.
Now, a really quick way to check the price tag is something called the price-to-earnings, or PE ratio. Right now, Globe Life's is about 10.7, but what's really interesting is that this is actually about 4.5% cheaper than its own average for the last 5 years. That's a little hint that compared to its recent past, the stock might just be on sale.
But let's get a little more precise. If you run a discounted cash flow analysis, which is a fancy way of estimating a company's true worth, the result points to a potential margin of safety of over 24%.
And this, right here, this is the heart of Buffett's entire philosophy. That margin of safety is your cushion. It's your protection against being wrong or just plain bad luck. A 24% margin of safety suggests the stock is trading at a pretty big discount to what it's actually worth, and that is exactly what a value investor dreams of finding.
So let's tally up the scorecard. Did Globe Life pass the Buffett test? Well, for having a predictable business with consistent growth, check. For having strong financials with high profitability and low debt, check. For being shareholder-friendly with a long history of growing dividends, absolutely, check. And finally, for the price, the data suggests a significant margin of safety. Checkmate.
You know, this whole framework, it isn't magic. It's just a disciplined, common-sense way of thinking about buying a business, not just a stock ticker. The principles are really simple, and they've stood the test of time. It kind of makes you wonder, what company are you going to put to the test next?